All right, guys, warm welcome to another week ahead video. This week's video will cover the trading week running from Monday, the 27th of September to Friday, the 1st of October. Now, with a very light economic schedule coming up this week, our attention will turn to a few tactical considerations that we have going for the Aussie dollar right now. Now, as you guys know, the Aussie dollar started off the year on a very strong footing, outperforming most of the majors, but it has slowly but surely become the biggest underperformer among the major currencies this year, especially after peaking out in late February. Now, even though the Aussie struggled for clear direction between the month of March and May, the downside has been more pronounced recently because there has been a few key drivers, of course, that has added to a lot of uncertainty for the currency, as well as some uncertainty, of course, for the policy outlook on the RBA side. Now, the first of these drivers is, of course, the virus situation. As a result of the outbreak and the subsequent lockdowns, as well as restrictions, the markets have now fully priced in a third quarter GDP contraction. And the big question right now is whether the economy will be allowed to open up early enough to avoid a back-to-back dip in GDP, which of course will spell recession. The second driver has been China. As Australia's biggest export destination, the current slowdown in the Chinese economy has weighed on the Aussie, and these recent challenges regarding the Evergrande company is obviously just one more thing in the mix to add to that bag of worries. The other key driver has been commodity prices, more specifically iron ore. According to the OEC data going back to 2019, iron ore made up close to 25% of Australia's exports, and the bulk of that is shipped to China. So that's a little bit of a double whammy, considering the fact that that China is going through a slowdown. So the over 50% drop that we had in iron ore prices has been a key focus of ours for the Aussie dollar over the past couple of weeks, and it is true that some of that was offset by the subsequent 24% rise in coal prices, but it wasn't enough to completely offset the expected hit to terms of trade. Now, even though these drivers, do add uncertainty for the currency, the recent CFTC positioning data shows that the markets might have overplayed its hand to the downside for the Aussie, especially if we start getting some possible positive catalysts coming into the mix. If we take a look at the most recent CFTC data from the 21st of September, the Aussie is currently sitting not only on the biggest net short position among the majors, but is also sitting on the biggest net short positioning on record for the Aussie dollar. And the pace of the positioning changes, reading well over 2 standard deviations on a 3-year, a 1-year, as well as a 6-month basis. Now, when you look at these types of extreme positioning happening on a currency, which in our view isn't yet bearish but more neutral, the term coiled spring does come to mind when we consider data like this. Now, it is important to at this stage say that just because something has reached a extreme level of positioning, whether to the up or to the downside, that of course doesn't mean that that currency or asset can't continue moving in that direction. So it doesn't mean that it's net short, extreme net short, that it can't continue to go lower, but it does mean that the chances of seeing short squeezes becomes increasingly likely for that particular asset. So even though the uncertainty for the currency remains intact, the positioning means that any type of short, a strong enough short-term catalyst could be enough to see some of the bigger shorts unwinding some of those positions. And once stops gets triggered to the upside, that could see a fairly big short squeeze developing in the market. So that's something interesting we're looking at. Now, with a very light economic calendar coming up this week, like we said, overall risk sentiment will be very important for the markets, and we'll be looking for any positive news potentially coming out from China. Firstly, with regards to the current Evergrande situation, looking for any de-escalation in that with that company, or any significant policy easing efforts coming out from the CCP as well as the PBOC. The markets right now are still expecting both Beijing as well as the PBOC to offer more stimulus, more support for the economy. So any announcements on that front could also be a positive catalyst as well. Now, the other thing to consider coming back to the commodity side is, coal prices have continued to rip higher more recently. And even though the bounce is, nothing too exciting, a bounce in iron ore to the upside at the same time is a little bit more interesting for us. Because remember, right now, if you take a look at if you take a look at where coal prices are heading, currently there's a few structural things we need to keep in mind for coal prices. Firstly, they've continued to move higher, mostly due to increasing demand outlook. It has certainly been exacerbated by the gas shortage, of course, more recently. But we also have a continued tightening of global supply right now. Places like Australia, for example, they're down 16% in the first half of the year in terms of supply compared to pre-pandemic levels. And as the supply is mostly driven by skill shortages and safety concerns, they don't see any type of quick fix for those types of supply challenges. So, in an environment where we can see coal prices remaining supported, but also seeing slightly more upside playing out for iron ore, that can be really interesting for something like the Aussie dollar. And that is something we're watching as well. The other one to watch, of course, is the virus situation. So if we just quickly take a look, at this chart. Uh, Current vaccination levels are very encouraging. We're sitting at over 60% of the population that has now been vaccinated, and over 40% of those, are fully vaccinated, meaning 2 shots. So at this speed, we shouldn't really discount the odds of some potentially good news coming out on the lockdown front. If we do see any major restrictions being lifted, that will of course be a very positive catalyst for the Aussie. So, even though we maintain a more neutral fundamental outlook for the Aussie dollar, which is, arguably leaning slightly more towards the weak bearish side recently, even though that's the case, we think trying to chase the Aussie dollar lower from these current levels, even versus the currencies that we're still bullish on, like the Kiwi, the pound, and the CAD, it just doesn't offer very attractive risk to reward opportunities right now, in our view. And we would much rather, look for any potential positive catalyst to look for tactical long opportunities in the short term versus a basket of major currencies. Now, if we quickly break down a couple of scenarios that we've been looking at. Firstly, if we see any type of support or stimulus measures being announced by the CCP or the PBOC, that can be a good trigger. If we see any announcement of a reduction of the lockdown measures in Australia, again, that could be a positive catalyst. If we see a softer landing in terms of the possible restructuring options for the Evergrande company, again, a positive catalyst. And then if we see overall positive risk appetite boosting the high betas, like the Aussie, that can also be a positive catalyst that can see some upside. Now, possible pairs to include in a basket against the Aussie. Firstly, is the Aussie Kiwi and the Aussie CAD. Even though we're bullish Kiwi as well as the CAD, again, looking at the overall positioning where we're at right now, looking how far some of these markets have traveled, one has to argue that at least some of them are looking a little bit oversold. But apart from that, the reason why we like the Kiwi as well as the CAD here is that all three of these are risk sensitive currencies. So in the event of strong risk on or risk of environment, you can be mitigated by adding some of that exposure. The other ones to look at is something like the Japanese yen as well as the US dollar. To diversify, really three factors. One is to have some safe haven exposure versus the high beta exposure of the CAD and the Kiwi. Also, we have the ongoing political concerns from Japan with PM Suga, of course, set to be replaced. So to mitigate some of that, for the Japanese yen, of course, we can add the US dollar. And of course, to mitigate some of the dollar risk like we had, like the infrastructure bill developments coming up, as well as possible Fed speakers, we can obviously add the yen. So we've got safe havens, we've got a mix of safe havens, we've got a mix of high betas, all of them really playing a different function in this basket. And the other one that's a little bit more interesting, a little bit more exotic, is the Aussie ZAR. We've been looking at this recently, as you guys know, not just the Aussie ZAR specifically, but the ZAR. And given the importance of iron ore in both these two economies, there is some asymmetry, we think, for commodity on the commodity side of things, with further downside in things like iron ore. That would be more beneficial for the Aussie and a bigger hit for the ZAR. And as long as coal prices stay elevated, even if iron ore prices do shoot up, that should once again be more beneficial for the Aussie versus the ZAR, as long as oil prices stay elevated. So we do think there's a little bit of an asymmetry there that could be interesting, and definitely one that we will look to include in that potential long basket. So that's everything from our side for today, guys. Again, you know, when we look at these types of opportunities, it's not something that has a fundamental bullish bias. We're neutral on the currency. These are mainly tactical considerations. So that means waiting and looking for those positive catalysts will be very, very important. We don't just want to open the market and buy the Aussie just because it's looking stretched. From a positioning point of view, we want the markets to have a reason to start unwinding some of those positions, and that means waiting for those really key catalysts is definitely going to be the best way to approach these types of opportunities. All right, guys. So that's everything from our side. It's going to be a quiet one out there. So again, don't try and chase every single ebb and flow you see. Wait for those clear catalysts, and if none of them show up, then have the discipline to rather stay out. Have a fantastic week ahead.